negative, but not perfectly negative. How to interpret it? How to interpret 0.68 negative correlation?
This is by 1. Why with this way?
Yes, that is correct. It's negative value of that. Why are you by perfect limit 0.6? That is really. If it is say here, say 0.58 positive. So when the x is increasing, y also increasing, but less than 1, 0.58. Because the perfectly positive. So likewise, you can interpret correlation. Now, calculate correlation coefficient for our example. Now you have everything in your hand. Calculate the correlation coefficient. Covariance minus 10.72 divided by standard deviation x, standard deviation y. The correlation model. That's the answer. 0.58?
5.
5. So your answer is here 0.51. Is it positive? No positive. Can't be positive. Covariance negative vela make a positive and bad. Negative. Is negative. Now you can integrate. Covariance correlation coefficient is negative. So when the x return is increasing in a particular time in the economy because of some event, say by 1%, by decrease by 0.5. Right. So now, are you okay? Any question? Any clarification? How many days last year did we get? We take a detail of lunch. We know it later. 2 sessions later, we make it. If we want to learn I know that this is great for you. Nothing is Mama. Amar what the thing again, but the feedback at the wildlife close. But the number. Our Pacific and telling that there are one. Take a support now, it's the girl, while I get support the Ghana. 20 marks of the Ghana. Right. Without inclusion, the Ghana, absolutely in the heart. Now make other Tiagan, or absolutely in the heart. Now, you can read this. This is some indication for the diversification. When the correlation coefficient is perfectly negative, perfect diversification effect is generated. When the correlation coefficient is -1, you have a chance perfectly. The standard deviation is that is the meaning. If the correlation coefficient is perfectly negative, you can perfectly diversify. Perfect diversification is possible. Portfolio standard deviation will be less than the weighted average of individual standard deviation value. Normally, diversification advantage of assess rule of thumb. We calculate the weighted average standard deviation value. Weighted average standard deviation value means X on standard deviation, Y on standard deviation, weighted average. X on standard deviation 50%, Y on standard deviation 50%. That is the weighted average. The weighted average standard deviation value is a portfolio standard deviation. It's a diversification advantage. Did you get that point? The Vibhagati or Ghana zero Alami with a diversification. So you can assess that simply by calculating weighted average standard deviation value. Normally, when the correlation coefficient is negative, that is happening. Our portfolio standard deviation is less than the weighted average standard deviation value. That is the norm. That is the benchmark. When the correlation coefficient is positive one, no diversification benefit. The correlation coefficient is perfectly positive, no diversification benefit, because portfolio standard deviation is equal to the weighted average individual standard deviation value. No diversification. And the correlation coefficient is 0, can be 0. There is a possibility to have moderate level diversification advantage. In reality, normally in the stock market, stocks are in between -1 to 0, 0 to +1. Extreme values are in the back. In the reality, in the practical world, perfectly negative way was there, perfectly positive way was there, 0 way was there. After the numbers correlation. Right? In reality, you will get the correlation coefficient between this range. So therefore, you will get certain level of diversification benefit. As far as the portfolio, as far as the correlation coefficient is not perfectly positive, you will have a diversification effect. Okay? That is the conclusion. Now, this is the expanded formula. Nothing difficult. Instead of the covariance, this is covariance. Previous covariance. Instead of the covariance, now we have substitute standard deviation X, standard deviation Y. This is correlation coefficient. So if you calculate using this, you will get the same answer. Don't worry about that, right? So these are the you will get the same marks. 2.2. Now, in this example, calculate the weighted average standard deviation value. Weighted average standard deviation value is how much? The standard deviation in x kiyada atara decimal. Hi. It's a better place. Standard deviation stop x 5.1 make it 50%. There is standard deviation y
4.67.
4.67 50% of it. The weighted average standard deviation value again
4.5.
4.51. This one of the answers zero. Make a 4.51. This is 4.51. 4.51. Now weighted average standard deviation value is how much? Weighted average standard deviation average standard deviation again x standard deviation again y standard deviation again weighted average standard deviation again. Right? 5. Take a next. 4.51. 4.5. So you can see our portfolio standard deviation is 2.28. So it is less than the weighted average standard deviation value. The correlation coefficient is minus 0.51. So therefore, if I ask the question, do you have diversification benefit? Yes, there is a diversification benefit because you can see the risk you can minimize 2.28. If you invest in the individual stock, this is the risk 4.51. If you invest only the Y, this is the risk. By combining, constructing a portfolio using this X and Y, you can minimize risk to 2.28 with a reasonable expected return. Portfolio risk is 3.4 or 3.42. So that is the rule of thumb. So you can check the weighted average standard deviation value with the portfolio standard deviation to decide whether there is a diversification advantage or not. If correlation coefficient is perfectly positive, no diversification benefit because portfolio risk is simply equal to the weighted average standard deviation. I'm stopping that point. So I will let you do some homework, read and look at these things carefully. So then I will read this thing when I come to the next day because I think it is otherwise overloaded. Yes, this thing I will read the next day, but don't come next day with a blank mind. Otherwise, I can't start at the so you have to come up with all these things after properly reading. So that from that point, I will elaborate this thing because that important things are there. But I know that it is been overloaded. Oh, right. So let's move to the quiz.